By the end of this video, you are going to understand exactly why your checking account is one of the worst places to keep your money in 2026, how much you are actually losing, and the simple moves you can make this week to stop the bleeding and start putting that money to work for you instead. Let's get into it. Here is the simple truth that most people never think about. Money sitting still is money moving backward. That sounds strange, but hear me out. Inflation in 2026 is still running above the historical average. Even at a modest 3% annually, every dollar you leave sitting in a checking account is worth less at the end of the year than it was at the beginning. Your bank is not paying you anywhere near enough to keep up with that. The average checking account in America right now pays somewhere between 0 and 0.01% in interest. That means if you have $5,000 parked in your checking account, you are earning about 50 cents a year. 50 cents. Meanwhile, inflation is quietly chewing through the real purchasing power of that money at a rate that should make you angry. This is not your fault. Banks have spent decades making checking accounts feel like the safe and responsible choice. Keep your money here, they say. It is convenient, they say. And they are right that it is convenient. Convenient for them. Because while your money sits there doing nothing for you, your bank is lending it out and earning returns that you will never see. But here is the thing most people do not realize. This problem has a solution, and it is not complicated. The question is whether you know where to look, and that is exactly what we are about to break down. Let's pull back the curtain for a second on how banks actually work, because once you understand this, you will never look at your checking account the same way again. When you deposit money into your checking account, the bank does not just lock it in a vault with your name on it. They take that money and they lend it out to other customers as mortgages, car loans, personal loans, and business credit lines. They charge those borrowers anywhere from 6 to 25% interest depending on the product. Then they turn around and pay you 0.01%. You do the math. That is an enormous spread, and your bank is pocketing nearly all of it. This is how banks have been profitable for centuries. It is a legal and totally standard business model. But that does not mean you have to keep playing by those rules. The average American household keeps somewhere between $3,000 and $8,000 in their checking account at any given time. Multiply that by millions of households, and you start to understand why banks have zero urgency to offer you better rates. They already have your money. They already have your loyalty. And most people never question it. So the real question becomes, what happens when you do start questioning it? What options actually exist for your money in 2026? And more importantly, which ones are actually worth your time? This is where things get interesting. While traditional banks have been paying you next to nothing, a completely different category of accounts has been quietly offering dramatically better returns, and most people have no idea they exist or how easy they are to open. High-yield savings accounts, especially those offered by online banks, are currently paying between 4 and 5% annually in many cases. Compare that to the 0.01% from your traditional checking account. On a $5,000 balance, that difference means the gap between earning 50 cents a year versus earning somewhere around $250 a year. That is real money for doing almost nothing differently. These accounts are FDIC insured, just like your regular bank account. That means your money is protected up to $250,000 the same way it would be anywhere else. The main difference is that online banks have lower overhead costs, because they do not run thousands of physical branches. They pass those savings on to you in the form of better interest rates. The process to open one takes about 10 minutes online. You link your existing checking account, transfer money back and forth as needed, and your emergency fund or extra savings starts actually working for you instead of working for your bank. But a high-yield savings account is just one piece of the puzzle. There are two more strategies most people never combine with it. And that combination is where the real advantage shows up. Let's talk about two more tools that most everyday Americans overlook completely: money market accounts and Treasury bills. Neither of these is complicated, and both of them can fit into a realistic financial plan starting this week. Money market accounts are similar to high-yield savings accounts, but often come with a few extra features like check writing or a debit card. Rates are competitive, typically landing in that same 4 to 5% range. They are great for people who want slightly more flexibility while still earning a meaningful return on their cash. Treasury bills, or T-bills, are short-term government debt. You essentially lend money to the U.S. government for a period of anywhere from 4 weeks to 1 year, and they pay you back with interest. Rates on T-bills right now are hovering in that same attractive range. And here is a bonus that most people do not know. The interest you earn on T-bills is exempt from state and local income taxes. Depending on where you live, that could make T-bills even more attractive than a high-yield savings account on an after-tax basis. You can purchase T-bills directly through treasurydirect.gov with as little as $100. No broker needed, no complicated account setup. Just a few clicks, and your money is working for the government instead of sitting idle in a checking account. The key takeaway here is that in 2026 you have more options than ever before, but knowing about them is only half the battle. The other half is actually building a simple system around them, and that is what most people skip. Here is the practical framework you can actually implement. Think of your money in 3 buckets. Bucket 1 is your checking account. Keep only 1 to 2 months of essential expenses here. This is your operational cash for bills, groceries, and daily life. Nothing more. Bucket 2 is your high-yield savings account or money market account. This is where your emergency fund lives. 3 to 6 months of expenses, sitting in an account that is actually earning you something meaningful while remaining fully accessible. Bucket 3 is for any extra cash beyond that. This is where T-bills or other short-term instruments make sense. Money you do not need for at least a month, but do not want to lock up long-term. This 3-bucket system takes about an hour to set up and maybe 15 minutes a month to maintain. But the difference over a year or two is significant. On $20,000 split intelligently across these buckets, you could realistically earn $800 to $1,000 in interest annually instead of $2. Your bank has been benefiting from your inaction for years. The good news is that changing this takes almost no effort. The information is out there, the accounts are free to open, and the results are real. If this video helped you see your checking account differently, do me a favor and hit the like button right now. It genuinely helps more people find this information. Subscribe if you want more straightforward money content with no fluff and no gimmicks. And drop a comment below telling me how much you currently keep in your checking account. I read every single one, and I want to know where you are starting from. Your money should be working for you. Let's make that happen.